Bloomberg Audio Studios. Podcasts, radio, news.
I usually would dive in with Richard Clarida of PIMCO. He'd say, what's the market going to do? What's the Fed going to do? We're going to stop. And this is why we're talking to Richard Clarida today. Koch Lakota of Rochester, when he was Federal Reserve Bank of Minnesota, said of the theories wrapped around Professor Clarida, modern macro models do not capture an intermediate messy reality that's out there. Right now, there's a messy reality
Very messy.
that we're all facing there. And to me, looking at the magnificent architecture of DSGE, folks, I'll say it once, dynamic stochastic general equilibrium theory, and the beauty of it, and not the physics envy, but just the wonderful thinking of it. You come here, and as Ned Phelps would say, go to the x-axis, short-term, medium-term, long-term. Yeah. You're in the Oval Office right now, and you got to explain to Trump and the gentleman from Pennsylvania, Hassett, the short-term, the medium-term, the long-term of what they are doing right now. How do you explain that?
Well, what you say is the goal is to onshore, bring production back to the U.S., reduce the trade deficit. What we know is they can put on tariffs. They have the Liberation Day is tomorrow, but it will take several years for that production, if it eventually does ramp up, to boost the supply side of the economy. We have supply chains. Tariffs are essentially a tax on inputs to production, so that slows it down. Also, the uncertainty about what the policy will look like in the future as well. So right now, what you're getting is a lot of uncertainty. It's slowing the demand in the economy. Eventually, you may get more jobs and more production, but that's several years down the road. So right. I think I want the folks in the Oval Office to understand the time dimensions at work here, for sure.
Stephanie Kelton has a theory which is very much against people like you on what modern monetary theory should look like. And part of that theory is the intrusion of politics into monetary economics. Right now, we're doing almost Volrasian tariff law, McKinley tariff law, certainly, from the 19th century. Can the political system be patient enough to get declared as medium-term success?
Well, I'm not sure. And in particular, it gets at another fundamental idea in economics, which is the idea of time consistency, that eventually people figure out that your promise now may not be delivered in the future. And so that's why, in particular, if the 20% tariffs that we're hearing about are really the beginning of a negotiation, that also adds an additional layer of uncertainty on top of just knowing what the tariff number is now. You know, Tom, we saw when I was at the Fed in 2019, that in fact, just the uncertainty about the trade policy itself was a damper to the economy. And that's a very tangible fact of life in macro. And I think we're seeing an elevated version of it now.
And Richard, I think we're seeing some, the folks on Wall Street start to take down their GDP numbers, maybe ratchet up their inflation expectations. Are they too early here, or is that a reasonable, I guess, near to intermediate term outlook?
Well, you know, Paul, everything in macro is a probability. And so I think it is appropriate to move up the probability of a recession. It would not be my base case now, but it's certainly somewhat more elevated than it was. In particular, I think the other piece of this, Tom, getting back to your point about the about the x-axis, is there's a lot of talk about fiscal. You know, no tax on tips, Social Security, tax deductions to buy a car. But again, that's going to take most of the rest of this year to work its way through Congress. And so again, there'll be uncertainty over that piece of it as well.
And given that backdrop of uncertainty, Richard, is there anything Fed policy can do to really, counteract or to impact the economy? Because it doesn't feel like there's much the Fed can do in the face of what could be a slowing economy and higher inflation.
Well, I think here we want to distinguish between what the Fed can do and what they will do. You know, what the Fed could do is cut rates preemptively. That's more or less what the Powell Fed did during my time there in 2019. The economy began to slow because of trade policy uncertainty. Inflation began to fall. And so we cut rates, essentially an insurance cut. I don't think the Fed really now has the runway to do an insurance cut. In other words, we may need to see a very tangible slowing in the economy, in the labor market, rise in the unemployment rate to get the Fed off of hold right here.
If you're just joining us across the nation, we're with Richard Clarida, the former vice chairman of the Fed. We have a spectacular set of conversations for you today. Nancy Lazar will be with us later, among others. Michael Nathanson. Paul had a tantrum yesterday and said, get Nathanson. We have Michael Nathanson here with a interesting essay on YouTube. We welcome all of you on YouTube. Subscribe to Bloomberg Podcast. It's our wonderful new distribution. Thank you for a successful March, Paul.
Richard, so, it's interesting. Some of the the data that the Fed looks at, historical data, still shows the economy's in pretty solid shape. But boy, I get kind of spooked. I think the market gets a little spooked when they see survey data like the University of Michigan data showing that, boy, consumers really are concerned. Their sentiment is falling. Their inflation expectations are rising. How does the Fed look at that type of data?
It's an input into the projection. I think Chair Powell mentioned at the press conference last week that they look at the survey data, but the survey data doesn't necessarily translate into hard data.
Yep.
Eventually, I think what we have seen, even Paul, in the hard data is a pretty noteworthy slowing in consumption side of the economy relative to a really strong fourth quarter. I think a lot of reason why sell-side houses are marking down their forecast is not so much the survey data, it's the tangible data on consumption being very, very soft in Q1.
You more than anyone have got to go from the academics at DSGE and your work at literally building the modern Columbia program. Did you bring Woodford over? Were you the one that said, Michael, come on over?
I wish I could take credit for that. That was my successor, Don Davis, who brought Woodford over.
Very
but I
cool.
was leading the cheerleading effort to do it.
There was a cheerleading effort, and they used torpedo bats at the Columbia right now. So Richard,
but I did bring in Stiglitz.
Okay, you brought. Well, that
take credit for that.
Okay, that's good. Yeah. But the thing here, Richard Clarida, is to bring this over to the application of what we're doing now. The theories to me are literally out the window. What is the theory of the dual mandate right now?
Well, right now the labor market's where the Fed wants it to be. We have about a 4% unemployment rate and all broad measures of the labor market. So the Fed wants to keep the labor market where it is right now. Chair Powell has said a number of times that the committee doesn't think that the labor market now is a source of inflation. So they're very happy with where the labor market is. What they were thinking 6 months ago is that they were on a glide path to this soft landing, although they didn't use that term. And I think the glide path has been delayed somewhat.
My 10-year real yield here, Jerome Schneider called me up from PIMCO, who got up early. He says, Tom, the 10-year real yield, 1.78%. It's coming down, down, down. If you're talking to PIMCO troops right now, are you modeling out a higher unemployment rate? I got Atlanta GDP grim. I got Federal Reserve Bank of New York disagreeing with that. Where is Richard Clarida on the vector of the unemployment rate?
I think the risk is to the upside. And indeed, if you look at the Fed's projections 2 weeks ago, where they show a chart that what is the risk to the unemployment outlook, it's to the upside. So I think there's some upside risk right here. At minimum, given what's going on with Doge right now, we're going to see some increase in unemployment through those efforts. Also, important to note that even coming into the year, Tom, if you look at private employment, in particular, excluding healthcare and education, which have a pretty big government backstop, private employment had been really slowing throughout much of last year. So that I think that's also relevant.
How do you view the consumer here today, Richard? It just seems like anytime over the last 12, 15 years, you get concerned about the economy, but the consumer hangs in there and generally keeps spending pretty well. How do you think about the U.S. consumer?
Well, in the aggregate, there are 300 million consumers, and in the aggregate, they're in great shape. In particular, high levels of net worth. If you own a house, if you have money in the stock market, you've had a really good run for the last several years. But about a third of Americans don't own their own home or don't hold any stock. And for them, it's a very different outcome. So what you're starting to see in the data now is a pretty strong, if I may use the term, bifurcation between upper income consumers and consumers who don't own their own homes or have a lot of stock market wealth. And then they're getting pinched right
this is the heart of the matter. I mean, Alan Meltzer almost took a swing at me at Jackson Hole once over this, because Alan Meltzer wanted to go back to 47 and aggregate data. You've been teaching that for 25 years back when you were at Illinois. We're aggregating data. You just described a barbell, John Edwards, two Americas.
Oh, yeah.
Around the table at the Eccles building, besides arguing over who's got Redskins tickets, forget about that. But around the table at the Eccles building, are you looking at two Americas or some economic aggregated fiction?
Well, I'll punt and say you look at both, but certainly during my time there, the staff did very, very good work on looking at very disaggregated data. Forget, two Americas that were looked at like 38 different parts of the economy. So you do both.
Oh, come on. I mean, Jason Furman, in his wonderful New York op-ed, we'll get Professor Furman in up at a school in New England somewhere.
Yeah.
Jason says flat out, tariffs kill the poor and the tax cut goes to the rich. It's a single sentence in there. Surveillance correction, Lisa. Thank you for noting it. It's not the Washington Redskins. It's the Commanders.
That's
my
right.
folks' pa.
Oh, wow.
That's my folks. Excuse me.
Maybe we'll go back. Who knows?
Maybe I'll still have a job.
The world's changed. So, Richard, where do we go from here? What's the key thing that you're looking at here for this economy? Is it the tariffs? Is it the consumer? Is it the labor market? What's the key thing you're focusing on?
Look, I think the issue is we're in a period now where measured inflation is going to go up because of the pass-through of the tariffs, and activity is going to slow. So the real question for me, Paul, is are we going through what I call a whiff of stagflation, or are we really entering what would be a pretty persistent stagflationary crunch? I'm still relatively optimistic. I think it's more of a whiff than a new normal, but it's certainly something that would be quite relevant. Yeah.
It seems like a tough political call there to slow this economy and the rise in inflation. Is the longer term gain that this administration sees from perhaps reshoring more manufacturing, is that a realistic expectation, do you think?
Well, it is a realistic expectation, but it will not happen overnight. It will take several years. And in particular, in fairness, we saw a version of this in the Reagan administration. People think of Reagan as being a free trader, and he may have been philosophically, but the Reagan administration which I actually worked with back in my youth, was actually quite interventionist. In particular, they had a policy known as voluntary export restraints on Japanese cars. And what the big Japanese automakers, Toyota and Honda, realized is the only way for them to have a presence in the U.S. was to build a lot of factories in the U.S. And so
that worked.
An ambitious enough trade policy can lead over time to some onshoring, but it won't happen overnight.
I got 8 ways to go for a final question. I want to go to zero sum, but it's too early in the morning for a zero sum discussion here. The heart of the matter is a president is looking at this as a bilateral discussion. The giant William Klein at the Peterson Institute aggressively disagrees with that. What's our multilateral outcome of this bilateral naivete?
I think we'll learn a little bit more tomorrow about how much of this is intended to be permanent and how much is an opening, art of the deal negotiation. If it is, as I suspect it will be, the opening rounds of multiple negotiations across different countries, then it's certainly not going to be. It's certainly not going to really be a multilateral plan. It'll be a series of bilateral deals.
Is GATT gone? Pardon the phrase. Is GATT gone?
And I think the evidence in favor of that is that the Biden administration really didn't try to resuscitate the WTO. So
why didn't they? Why didn't they resuscitate the Atlantic Charter off of Newfoundland in 1942 when we were flat on our back?
Well, you would have to ask them, but the political center of gravity in the last 4 years before Trump 2.0 was really not to engage in the WTO. We never staffed up the dispute settlement process.
That's completely fair. I mean, it goes back to Trans-Pacific failure.
Yeah, and very good reminder, the Trans-Pacific Partnership, exactly. Yep. Yeah.
You going to come in tomorrow for Liberation Day?
I'll do it by phone. How about that?
Richard Clarida, thank you so much. Generous of you to be with us.